real estate losses and 2025 predictions. What a big mix-up. Scott Besson. Who is this guy? We're going to talk about all these things today. Welcome back to the channel. Dave Sousa, we got him on from Glendale, California. Dave, welcome aboard again, pal.
Nice to be with you, Cash, and nice to be with your listeners. Happy holidays to you all. Good to be here.
Great, man. Always have to have you on board. We're going to talk about some things. The 2025 predictions, they're conflicting. They're all over the place. We've got to get into that. We've got to look into the big golden crystal ball today and see what we think, what we feel is going to happen for 2025. We also got to talk about Scott Besson, Trump's treasury pick. This guy's an interesting guy and has quite the portfolio in real estate. And he's had lots of losses in real estate as well as gains, too. And we're going to talk about Chicago a little bit, what's going on downtown Chicago, talking about real estate losses right now. Let's get into that a little bit. Dave, before we get into that, though, could you tell us a little bit about what's going on in our mortgage world today, interest rates, all that fun stuff? Take it away, Dave.
Yes, sir, will do. So here's a little bit of recap of what happened last week. There were a couple things that were pivotal. Fed Chair Powell spoke about the economic outlook and the Federal Reserve's economic outlook for the future, and seemed a little more tepid about rate cuts in the future. But Wall Street seemed to like what he said, because after he got done speaking, bonds and stocks both rallied a little bit. Here's how the weekend rounded out. Interest rates ended the week about 0.125%, or an eighth better in rate than the week before, so that's a good thing. As of close of business last week, our par rate on a conforming 30-year fixed at primary residential was 6.25%. And stocks ended up the week about an average of about 1% up. There's three. There's the NASDAQ, there's the S&P, and there's the Dow. And they all have different movement, but typically the NASDAQ is the highest, and then the Dow may be the lowest. But the average of the three was about a 1% increase. So everything moved in the right direction last week. Unemployment numbers came in a little bit higher, or jobless claims for the week came in a little higher than expected, which was good for rates. But the November jobs report came in quite a bit stronger than anticipated. As you remember, in October, there was only 12, in the last jobs report for October that came out early November, only 12,000 jobs added. There were a lot of strikes and things going on. This time around, they were expecting 214,000 new jobs, came out 227. So that was really good for Wall Street. Not as particularly good for interest rates, but good for Wall Street. And as you know, we talked about last time, the last potential rate cut for the year coming up on December 18th, when the Fed concludes their 17th and 18th meeting. And that will be anticipated to be a quarter-point cut, and the last one for the year. So that said, that's a quick recap of what happened last week. And from here, Cash, you could take it away.
Well, great, Dave. Thanks for that update, man. So rates, par rate today with you guys, I know it's always a little bit less than what the average is out there, because you guys got some really aggressive competitive rates. Where are you at right now, again, with that 30-year mortgage for par?
As of Friday's close, par was 6.25%. So at a 6.25% on a 30-year fixed, you don't spend any money to buy the rate down with PRMI. Okay. And that's on a standard conforming 30-year fixed, solid credit, good ratios, basically a cookie cutter, fantastic loan. Our best case pricing would be 6.25 on a 30-year fixed. You don't have to spend any money to buy the rate down. You just pay your costs.
Perfect. So if somebody did want to get down and break that 6% barrier and get into the high fives or 5.75, it's going to cost some money, but not as bad as it used to be, right? We could also get the seller to help pay that and get that rate down further for you, right?
Absolutely. And this isn't an exact rule, because it varies depending on the yield curve. But for every approximate quarter-point drop in the interest rate, it costs about 1% of the loan amount. That's a fairly linear, it's not a linear relationship, but it's approximately that. So if you were to pay an extra 1% up front in an average market, that would translate to about a 0.25% drop in the interest rate.
Great. Dave, let's circle back around to your speculations for rates in 2025, and we're going to look into the golden crystal ball here and see what we both think about 2025. I'm really excited about, we have Donald Trump in here now taking over as president, and his huge, impressive real estate background with development and everything he's done in New York City and all over the world, too. And then, interestingly enough, his pick for the United States Treasury pick is an interesting guy. Is Scott Besson. We're talking
about. Yes, U.S. Secretary of the Treasury.
Correct. Yeah. This is a guy who's got a lot of real estate portfolio and background and experience in real estate as well. So this is going to be interesting between Trump and Scott Besson running the Treasury. Scott actually owns a piece of banking history, actually, in South Carolina. He bought a pink stucco building, Charleston, South Carolina, that housed the branch of the first bank in the United States, started in 1790. So he's running around buying mansions that have a lot of history. So a real historical element to all these mansions that he's buying. And he did admit that he's had some good successes in these purchases and he's had some losses, you know? And that's one thing we're going to talk a little bit about today, too, is losses in real estate, because that does come up. And so we want to look into that a little bit. Losses in real estate. Yes, you could lose your shirt in real estate. You could lose your shirt in the stock market, as we've all heard and seen that. But in real estate, yes. Although you got a guy like Ryan Serhant just said real estate, in his opinion, is about the safest investment you can make long term. That's the key words, long term. If you're trying to flip property and be an investor and that's your approach, yeah, you're rolling the dice on the market trends. The market can switch, it can move, there could be all kinds of things that could happen, and you could get caught with your pants down and lose some money on that deal because you need to sell now. You've got investors to satisfy, you've got banks, you've got to get money paid back. It could be a very interesting deal when you're going at it from that angle. Long term, real estate is a solid investment. Would you agree with that, Dave?
Absolutely. Absolutely. I mean, just, as a case in point, this may be a little extreme, but just spoke to a client recently. Their parents purchased a home in the mid 70s for about 50,000. And that home today is ostensibly worth somewhere around between 1 and 1.25 million. Haven't really done a whole lot to it. It's just what the market, what the area, et cetera, has done. Now, not all areas, this is in more of a metropolitan Los Angeles area, so not areas will have experienced such growth. But if you just draw a trajectory of the line, I mean, do the math. 1.25 million divided by 50,000. I mean, it's even over 30, 40 years. That's a pretty significant annual rate of return, long term.
Gotta love that. Absolutely. Yeah. One interesting thing you and I were talking about earlier when it comes to investing in real estate and buying real estate is from what angle are you coming from? Is this just purely an investment? And you and I both know too, we've worked with buyers, people that are buying homes for their families, themselves or their families to live in. And this is going to be their abode now. This is what they're calling home, right? But they come into it with more of this investor mindset. Where they've gotten this from, I don't know, because yes, real estate's a great investment. But it's a twofold dynamic, right? It's also going to serve as housing for you and or yours and or your family, right? So when people look at that from that angle, they want to buy a home for their family, but they also want it to be this strong investment. I've talked to some buyers and said, listen, you're buying this house. Are you selling it in 3 months? No. Why, are you selling it next year? No. I'm going to keep it for 5, 10 years. Then what are you worried about? I mean, the market's going to probably be like this through that time. It's going to have its ups and downs, and you're going to be fine. If you don't need to sell when the market's down and you wait for it to be a good seller's market, that's when you sell the property, right? And you're not going to lose that way. But when you have to sell a property, when you're forced to sell a property, sometimes that happens whether you want it to or not. That's where these losses can really occur, right? Would you say so?
Absolutely. And to draw another angle to your perspective, when you buy stocks, most people just buy stocks. They might look at the day and say, okay, today's a good day. And then they jump in and they buy the stock.
Right.
So if you're day trading, different conversation.
Different story, yeah.
So it's the same mentality. Are you looking to flip or are you looking long term? Because to your point, if there's a 2 or 3 or 4 or 5% swing in the price from where you'd like it to be, the thought process to think about when you're thinking about investing in real estate is to take a step back and say, is this a short-term investment or is this a long-term investment? Right. And to your point, am I buying this as a home that my family wants to live in, which has a substantially higher emotional component to it?
Oh, yeah.
Or am I buying this like a stock as an investment where it's purely an investment and there's no emotional attachment to it?
Yeah. You live in that house for years, you pay down your mortgage, you take advantage of all the tax deductions along the way that you can, and your equity starts rising as well. So it's a win-win long term. But if you're trying to play it like a stock market or a day trader or a big time investor flipping properties, yeah, you are rolling the dice when it comes to that. So please remember that. But long term, you look back at houses bought in the 20s and the 30s, and you'll see the charts going like this, right? But guess where they're going? They're heading up all the time. We could have all bought houses for $40,000 and $50,000 a long time ago, but today those same houses are, you're saying, you were telling me stories that bought something for 50 or 80,000. Now it's 1.3 million, I think, right? Is that right?
Exactly.
Yeah.
2,000. I mean, you're looking at over 2,000%
right
improvement in investment.
And that's not to mention the write-offs that you had along the way and everything else that goes with that.
Correct.
Right. So yeah, pretty outstanding. Just like Ryan Serhant said, I'll go right back to what he said earlier. Real estate is your safest investment by far, long term. Long term is the key. Okay. So keep that in mind. Let's talk about, speaking of the losses, talking about Ken Griffin, this hedge fund manager that was also the founder of Citadel, right? This guy's got more money than God, and he owns a lot of real estate, a lot of very luxury real estate in Chicago, downtown Chicago. He's been trying to sell some properties and selling some of them at a loss. Why? That's the big $1 million question. Why is he selling these properties at a loss? Because they're in Chicago, downtown Chicago, right? It's been hugely affected by a couple things since 2020, right? Since COVID. They've had their issues, they've had their problems, and they had the George Floyd issue after that. And crime has done nothing but keep increasing in downtown Chicago. The number is right around 36% year over year with the crime increases. That, people are getting shot, people are getting, the carjacking numbers have gone way. Murders actually have gone down in the last year or two, but carjackings have gone up from what I understand. People getting robbed and mugged and, just so many different things going on. So the real estate is taking a big hit downtown Chicago. And then you couple that with interest rates too, it just makes it a nightmare. Now the suburb areas are doing fine. They're okay. It's downtown we're talking about Chicago. Have you had any wind about that or heard anything about that, Dave?
Not particularly. I'm licensed in California, and most every business I do is in California. While I wouldn't be surprised at what you're saying, I'm actually you talking about it now is the first time hearing of it. But I wouldn't doubt it. I actually have family that live in downtown Chicago. But again, we're all caught up in our lives, so I'm not that aware of real estate in downtown Chicago. But it wouldn't surprise me because crime rates and things like that. Yeah. Those are the type of things that have a very, very severe effect on real estate market.
That's right. When you buy downtown like that and that kind of lifestyle, you roll the dice with that. So make sure you're looking at a city where they're not going to put up with that crap. There will be no crime in my time here downtown. You got to look at the mayor and who's running the program there, and you want to make sure that they're on top of their game, right? So in Chicago, something has to get figured out. I'm sure there's going to be a lot of pressure because a lot of companies in downtown Chicago are moving out too, So just like
because of the crime?
Sorry?
Because of the crime?
Yeah. Well, crime in the real estate values is plummeting. It's no good. So I feel a little rebound and come back at some point, but for whatever reason, Ken Griffin is not wanting to wait around for that. He's got some other ideas with his money. So interesting to see. So a lot of people see a guy like that making moves like that, and they start thinking, "My God, why is this guy, selling off all this real estate?" Well, it's not because the market's crashing or he sees a crash coming. Maybe he does, but it's also because the real estate he's selling is in an area that's just been crashing down. Chicago, downtown Chicago's having a rough time. So next thing I want to talk about a little bit, Dave, was one of the things that have been searched on Google quite a bit is how to write a good offer when you're trying to buy a house. And the most important thing I could start out with, the number one element, because 90% of buyers are represented by a real estate agent. That is the statistic today. 90%, 9 out of 10 have a real estate agent representing them. Make sure you have a very good real estate agent. Okay, somebody
like Cash McCallum.
Yes, that would be a great place to start. Yes, 100%, and end the deal because you've got somebody good that knows how to write these offers. Because I've been on both ends, listing the property and representing buyers from all kinds of different price ranges, right? Regardless of the price range, though, regardless of the city you're in, you have to know how to present a proper offer. Number one, you have to communicate with the listing agent if you're the buyer representing the buyer, and you have to understand the comparables in the area. I've had agents send me comparables trying to get our price down on my listing for my seller, send me the comparables and say, look it, they're not matching up. I don't understand. We want you to come down to this price. Okay, it's a nice little game you're playing right now, but you sent me all the comparables that are wrong. They're in the wrong track. They're not even in the same area. They're a couple miles away. Well, I couldn't find any comps. Listen, if I can find 3, 4, 5 comps in the same tract, right? Or the same community for a house, that's all the appraiser needs. They really need 2 or 3. That's it. If they can't get them, they will go outside of that area and search deeper. And they'll even go further than 6 months. Like I sold homes in rural areas, horse ranches and different kinds of properties like that. And it's slower amount of sales, so hard to get comps in 6 months. What's sold to support the comps, right? So they'll have
what advantages realtors have over appraisers is there may be stuff going on that's not on the MLS, or it may be pocket listings and something that's closing. So you as a realtor have that advantage, especially in your local workable marketplace. And that's data that you should absolutely take to and share with appraisers if it supports your price.
Right, absolutely. We have a house on the market that this person was writing an offer on. It would have been a really nice, very good deal for this buyer to get the house, right? Based on it had fallen out of escrow once already from a loan situation that didn't come through at the end. So we're back on the market. The buyer could have done real well here, but because the agent representing that buyer just didn't understand the comps, didn't understand, they were wanting to try to finagle a big deal. Okay, here's a family trying to buy a home for themselves and where they're going to be working their job. They're self-employed, right? It matches everything they need, but they wanted a nickel and dime and nickel and dime. It became so much more important for them to nickel and dime and save a few dollars instead of just buying the right property. Because our deal as real estate agents is to bring the deal together, right? It's not about all for the seller, not about all for the buyer. Just bring them together. The seller's got a price, the buyer's got a price. Okay, let's make that work for everybody, right? And what I explained to the agent, because they thought it was just way too high, right? And they wanted to come way down here. And I said, listen, your buyer doesn't want to rip anybody off, right? No. The seller doesn't want to rip anybody off, right? No. What they all want is a fair price for their property. The seller wants a fair price. The buyer wants to buy at a fair price. They don't want to overpay. They don't want to undersell. So here's what you do. You write an offer that's going to get you into escrow, get the deal going, right? Somewhere in the ballpark. We bring that escrow together. We sign, seal, and deliver. Now, you have an appraisal contingency. If you have that appraisal contingency in there and the house doesn't appraise at the price that you feel is too high, well, then you can walk away from the deal. You have that protection. And I've had to explain this to a few agents before. Being on the listing side of things, you have to coach a couple agents that just don't quite understand how those things work.
And on the flip side of what you just said, if the appraisal does come in, then by definition, the price wasn't too high.
Exactly. It's a fair deal. The appraiser ran all the comps, brought all their experience and their knowledge, and they said, hey,
I mean, you could almost think of the appraisal as a safety net.
100%. It's for the buyer. 100% for the buyer. It's a big safety net. That's why that appraisal contingency is available in the RPA, the residential purchase agreement, the contract, if you will, when they write an offer to present to the seller. You have that there to protect you. So I've coached the buyers, agents, listen, your buyer wants his house. The buyer can afford this house, but they don't want to overpay. I get that. I understand that. So write the offer that we can get the deal put together, open escrow, leave your appraisal contingency in there, and you are protecting your buyer. You're doing your job correctly. You're getting them a really good house at a good price, and we're gonna find out if it's a fair price with the appraisal. And then if it appraises, great. If it doesn't appraise, right? Well, the seller has the option of bringing the price down to a number that makes it work for everybody. Now, does the seller have to bring it down? No. The seller will say, no, I'm gonna leave it here. And then the buyer needs to come up with a little bit more money to seal the deal. Or I've seen happen a lot of times, the seller will bring down the price, the buyer will bring in a few extra dollars cash, and then we'll close the deal that way. Or the buyer, if they just feel it's just an unfair deal, they can walk away. They have that contingency protecting them. They can cancel and walk. That's it. I've had to explain that to a lot of different buyers agents that didn't quite understand it. And I know you too, Dave, on your end of things with the lending, because we've had lots of discussions with different agents. I've even, we had to do cross qualifications and things of that nature. It's pretty interesting, isn't it, Dave?
It is, and just as an example, just literally one of the few escrows that we are in the process of closing next week. The appraisal came in a little bit lower than the sales price. The
Right.
buyer said, "Okay, I'll pay the price." They came to an agreement. They went into escrow. The appraisal came in lower, and lo and behold, just like you're saying, the buyer and seller agreed to lower the purchase price to what the appraisal came in at. Now they didn't have to do that. They could have canceled the escrow. That was one option. But they both agreed, okay, the appraisal came in, and the appraisers are generally, they're not biased towards the buyer or seller. They're
Right.
biased towards what they feel is the appropriate value.
Correct.
And granted, they make mistakes, but this particular appraisal came in, we had it reviewed. Everybody felt like the appraisal was appropriate, and the seller and buyer agreed to lower the price. Now, that may not always be the outcome, but it's something that certainly supports the trend of action that you were suggesting.
Right. Yeah. 100%. And that's what that is there for. So as a buyer agent, please exercise that, And this is another part of the job that a listing agent has to do. We get agents that bring offers to us, and
Mhm.
we have to be able to decipher the difference in the experience level of that buyer agent representing the buyer. So
And
please,
because sorry, go ahead.
as a buyer, make sure your agent is savvy. They are savvy. They are experienced. They know what they're doing. They know how to make deals happen. And that's from obviously having the experience and the knowledge, number one, and the market knowledge, right? But also how to communicate. Huge. You've got to know how to communicate with other agents. First, your buyers, you got to know how to communicate with them, and the sellers and the listing agent that's representing the sellers, right? To put these deals together. So important. Couldn't say anything
And
more.
to your point, exactly to what you were saying on this example I was talking to you about, the list price was actually lower than the initial agreed upon price.
Right.
And the buyer had trepidation about going up to that higher price. And their agent, very tactically and very, very straightforwardly and very honestly and very clearly, said, "Hey, there's an appraisal contingency. You're protected. If the appraisal doesn't come in, you can either walk away or the seller has to lower the price." So because of that appraisal safety net, the buyer agreed to proceed with the price, which was slightly higher than what they wanted to pay.
Right.
And lo and behold, just like you said, the appraisal came in, everything fell under the safety net, and nobody got hurt.
Right. Right. And as listing agents and buyer agents, you have to remove the ego. A lot of agents get this big ego, right? Because maybe they're being challenged with the knowledge that they may or may not have at the time, or a little confusion that might be sitting there. So my job is to not offend anybody. I can't offend anybody. My job is to try to bring the deal to the table and make it happen. However, I have to do that. And ego is not the way to do it. Insulting anybody, pissing them off, making them feel, uncomfortable. Can't do that. Have to bring it to the
Unfortunately, ego is a much greater part of what you and I do on a daily basis than it should be, or in many other things for that matter, too. And I would offer you that the minute and the more ego gets involved in the process, the less we are all serving the buyers and sellers that we represent.
That's right. You have to remember that. You always have to remember that you're serving your seller or your buyer. So if you're a seller or a buyer, just make sure you're getting an experienced agent, a knowledgeable agent, and one working from a place of ethics, and it has that mindset as well that they are working for you. So, anyways, let's look into the big golden crystal ball here next, because there's a lot of people that are wondering out there. There's so many different YouTube channels and things on the internet, and people going on Instagram and Facebook, and you've got all these experts because they're not even in the industry. They don't even really work in the industry. They want to sell fear, right? A lot of those guys call them the crash junkies, right? They're always talking about the big real estate crash coming. Well, they've been talking about it forever, for years and years and years. Guess what? One day they'll probably be right at some point. And I think that's what they're hedging on right now. But it hasn't happened, and I don't see a crash happening. I'm looking into my crystal ball. Anything can happen at any time. We're in such a volatile world. Now that we have the president selected, right, and we all know who that's going to be, that has calmed a lot of people down already, right? I've seen consumer confidence start to pick up. And if you look at all the statistics after every election for years and years and years and years, right after the presidential election, whoever's picked, left, right, it doesn't matter. The market usually picks up right afterwards. Are you on the same page with that, Dave?
I would agree with that. Yes.
Okay, yeah. And I see that already. I see a little consumer confidence picking up. And, our interest rates, if our interest rates start working with us a little bit more, Jerome Powell, you listening, by? Come on, bring that rate down a little bit more. Let's get down to that, break that 6%. Let's get down to that high five, somewhere in that ballpark. I think our market will really start to pick up. I think a lot of people are banking on that. So looking into the golden crystal ball here, Dave, if you can see it from your end, what do you see for rates? You are a very experienced lender in the market. You know about investments. You know about the stock markets. You follow all these things. You're a smart guy. What do you say? What do you think? I know pure speculations. We're just looking into the golden crystal ball. What do you think is going to happen for 2025 with interest rates?
Well, I'm going to give you what I'm realistically hopeful for, and then I'm going to follow that up with what I think is closer to what might actually happen.
So we could
What I'm realistically hopeful for is rates in the mid to low fives. What I am more my less optimistic view on it, based on what a lot of what's transpired both just before and since the election. I think if we see rates in the upper fives to six, up to 6% ish, that should be the trigger point for people, because while I'm hopeful to see rates in the mid to low fives, I know that what it would take for inflation and the jobs market to overcome to get there, we're not quite there yet. And even just literally a couple of days ago, the Federal Reserve Chairman on Wednesday of last week spoke, and he sounded a little less enthusiastic about future rate cuts than he did before the election. So while he is still confident that inflation will continue to come down, the rate at which that they're anticipating it will come down is not as rapid as they might have anticipated. There are some members of the FOMC who are also concerned that with certain changes in fiscal spending, depending on the administration, we could see inflation maybe even trickle the wrong way. So I would suggest, whatever rate you have, if you're waiting for rates in the mid to low fives, you might be waiting longer than you want. I would say if you see rates, like right now, our par rate is at 6.25. So if you see that come down to the 6%, 5.99% rate, I would execute.
That's good.
And if it gets better than that, you can always refinance later. So hopeful for mid to low fives. What's a little bit more realistic, upper fives to about 6%.
You don't see us getting into the fours, right?
That has not been part of any discussion that I've heard for quite some time now.
Yeah. And for a lot of people,
I would almost describe that as fantasy land at this point.
Yeah, I don't want to keep repeating myself, but every time we have these chats, we talk about that. And if anybody's waiting for those rates to get back down to 3%, something catastrophic is going to have to happen in our world, our United States. It's going to be bad. Something bad is going to have to happen to get to those rates again.
Or another pandemic, something along those lines. Yeah.
You want to know what happens every time something like that happens? Everybody gets scared. They panic. They don't want to buy. They hunker down. Now, COVID actually wasn't bad. We actually got people buying homes. That could have had something to do.
Here's the thing, though, to your point, not initially. When COVID happened, everybody froze. Mm-hmm. And then it was once the initial shock of what had happened wore off a little bit, and people realized interest rates are really good. There were a lot of refinances, and then, of course, people did start buying because they realized, hey, you know what? I'm not going to be able to get 2-3% again.
Right.
But initially, when it first happened, you're absolutely right. People froze because they didn't know how much worse it was going to get. They didn't know if we were all going to be here next week.
Yeah, right. So please, out there, listen. Exactly, 100%. So listen, if you're waiting around for those 3% rates to come back, not going to happen. I don't see it happening, right? Unless something really bad happens. And we don't want that. We don't want something bad to happen for those rates to come down that low. And if they do come down that low, are you going to be the buyer that's going to have enough grit, right, to go forward anyways with these big purchases during times of, major stress and fear? Probably not. Most aren't. Most don't.
With 32 plus years experience and seeing a lot of different markets come and go, I'll just repeat what I said a little while ago. enthusiastically hopeful, mid to low fives, more realistically hopeful, and more realistically probable,
Yeah.
upper 5 to 6%. And we're almost there now. If you think about this, we're almost there now. We are at our par rate right now is 6.25%. So about a quarter to 3/8% improvement.
Yeah.
And I'd love to see the floodgates open at that point.
Right. And the lower those rates get, the more activity we're going to get. A lot of buyers are going to keep popping off the fence, coming into the market, and prices going up. So not huge price predictions or speculations for 2025. Kind of standard as far as growth numbers go. NAR, National Association of Realtors, is calling out for about a 2 to 2.5% increase in prices, which they are the lowest one on the spectrum when it comes to the speculations for price increases for 2025. Redfin, Realtor.com, they're all calling for higher ones. They're all calling for like 3.5 to 4% increases. Regardless, let's just look at 2% for a low, 4% for a high, right? For these different analysts, right? So if you're waiting for rates to come down and you're still not buying, and you got your family in a rental and you're going back and forth, what do I do? What do I do? You're not building any equity.
Or you own a home that's not quite right for you.
Exactly. And you're not getting the tax deductions, and you're still waiting, and the prices are still going up. They're still maybe slower, but still up. So you got to really think about all these things, right? And make the best move that's going to be good for you. Getting into owning a home long term, best investment there is. Check out Ryan Serhant. He will agree with me 100%. And I know Dave will too. And just about anybody else we talk to that's been in the investment world of any sort. Real estate is a solid investment long term, right?
And the other thing, this is a human nature thing, but whether it's a purchase of a house or a car or a stock, natural human behavior for most humans is to procrastinate and wait. Well, let me just wait and see what happens.
Right.
And you don't want to spend your whole life waiting to see what happens.
Not
it
at all.
takes people with courage and commitment to say, hey, I've done my homework. I think I'm going to do this now, and look at it objectively and say, even if I pull the trigger now, I can refinance later. I have options in the future. And so I think that's the trap that a lot of people fall into, is the let me wait and see what happens trap.
Right.
And some of those people have been waiting to see what happens for 5 years, 10 years, 20 years, 30 years, waiting to see what happens.
I've seen it
If you're
happen.
committed to the process, I say you're very close to execution point.
Yeah, get there. Get real close, guys. So keep an eye out. Dave and I will keep you informed. Stay tuned. If you have any questions, reach out. We'll make sure you know up to the minute what's going on with our real estate market, our prices, our interest rates, everything real estate that you need to know. We're going to tell you exactly what's going on and how it is. No bull, no bars at all. We're going to let you know what's going on, okay? So,
and by the way, please let us know your thoughts on these podcasts. And if you have questions related to real estate, mortgage, finance, or the financial markets, send those to Cash. We can discuss those on the air here. And
if you want more cash in your life every day, hit the like and subscribe.
And I think we can all use a little more cash.
We can all use a little more cash. I like that, Dave. We all use just a little bit more cash. Love it. Hey, everybody. I hope everyone's enjoying the holidays. It's coming up, the big Christmas. So hang in there, get your shopping in, and have fun. We'll see you next time.
Happy holidays, everybody. Thank you, Cash.
You betcha, man. Thanks, Dave.